The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. First of all, I'd like to send along our condolences to Ed Young's family. What a great guy he was. There's not much more you can say about that. He was one of the real good guys in this business, and he'll be sorely missed by his family and certainly everybody at TFNN and anybody that even met him. Just a really super guy. Okay, I want to start today's show with the Bradley model from way back in March of 2009. And just to give you an idea of what was happening at that time, we all know that, all the banks were failing and Congress was out trying to get money to keep the banks alive, and the world was coming to an end. And Hank Paulson, told the president that, the end of the world was near, and we had to have all this money. I think he started with $700 billion, as I recall, and of course now, we're in the trillions. So, This is what we were looking at. The Bradley model is basically a cycle model that looks at cycles. Sometimes it's wrong, and sometimes it's right. All I can say is when it's wrong, it's really wrong, and when it's right, it's really right. That's all I can say. I'm going to try to give you some information today. What you are going to do with it is going to be totally up to you. I know what I'm going to do with it, but it's a case for something really serious is happening in our economy. It doesn't appear that anybody seems to be worried about it right now, but that's exactly what's happened. The second chart that I had posted into the Tiger TV today was from the headlines of the USA Today, and that is the fact that that there was a smooth rolling in stocks or smooth going in stocks. I forget exactly what the headline was, but it was, something saying that it was going to be, pretty easy from here on. Oh, the bull run is on solid footing. That's basically what it said. So I'm sure we were not on solid footing when we were there on May the 5th of 2000, but unfortunately, that's what happened. Now, I'm going to post another chart into the room, and that is the Bradley model of what we are looking at right now. This is the current Bradley model. We're over what we think is a pretty big cycle high, and we have some really big things happening in the market from a technical standpoint. I realize I am not a fundamentalist. I don't look at earnings or any of those things, cash positions or any of that stuff. All I'm looking at is patterns. I believe in these patterns because I've seen them work far more than they fail, and they work on any time frame, and we're going to look at some really, really long time frames. We're going to go back and look at monthly charts and show that there's something really big happening in the markets as we approach this coming 1st of June, and of course we had the sell in May and go away. And all you had to do was buy in May and hold it to the end, and it would have been okay. But we're looking at now, I'm going to post into Tiger TV, the long-term Dow chart going back just about 20 years. In fact, it is just a little over 20 years. And what I would like to have you take a look at here is to see this, what we call this expanding triangle, this 1, 2, 3, 4, 5 expanding triangle where, wave 2 goes below wave 1 and wave 3 goes above wave 1 and wave 4 goes below wave 2, and then the final wave making the tree drive to a top pattern occurs, and that's what we're looking at right now in the Dow Jones Industrial Average. I thought the Dow would top somewhere around 15,250. We've actually gone a little bit higher than that, but, it's close enough for government work. Because all of these charts that you're seeing now, when you look at this pattern, this 5-wave reversal pattern that was also known as, or the expanding triangle, also known as a T6 pattern in Gartley's book, this is the pattern that you're seeing in London. This is the pattern that you're seeing in Germany. This is the pattern that you're seeing in France. This is not the pattern that you're seeing in Asia, because Asia has been in a bear market since 2006 and has not rallied very much. The Nikkei has just completed a 786 retracement on a monthly chart up around that 14,800 level, and so that it should also be topping. So all of these charts that I'm looking at all across the globe are all telling the same thing. There's something big coming, and it doesn't look like it's going to be good. Now, this could be totally wrong, and this pattern fails this time, but for all of them to fail would be highly unusual, because this is one of the most stable and the most highly predictable of all the patterns that we have in pattern recognition, because you have so many ratios to base everything on, and when you're looking at the symmetry that's there, it really makes you very, very aware that this could really happen. I'm going to show a little bit later the chart that was happening in 2007, when we were making this same type of pattern, this expanding triangle type pattern, and it was also telling us that there was something very ominous coming as we went into October of 2007, and of course then we rolled over and came down. This time, I believe it's going to be a lot worse, and the reason for that is that these patterns are everywhere. I mean, they're across the globe, and it's like a giant jigsaw puzzle that's been put together, and I don't know what's going to trigger it, and I'm hoping I'm wrong here, but it looks like something really sinister is coming our way. I'm not going to repeat this as far as I don't want to be known as a doomsayer or anything like that, but I am preparing myself and my family for something on the downside here. Looking to be the short, getting on the short side of these things. If the S&P goes below 1620 in the S&P, then I would think that we would be that would trigger the mechanism that would cause these things, to go, to the downside. We already know what the bond market looks like, because we've watched that over a period of time, and I wanted to post into Tiger TV the long-term Bund, the German bond, the 10-year, going back over the last 8 years. It's also making a three-drive pattern, and it's also just completed a double top. And, that's just the German bond. I mean, the others are doing the same thing. And, of course, we know what's already happened to our bond. It topped, several months ago. And so there's something big is getting ready to happen, folks. So, try not to get too involved with the emotionalism of, things like Tesla and stuff like this, where they're trying to, feed you tripe and telling you it's filet mignon, because that's usually what happens at times like this. So we have to be extremely careful here. We already know that the Dow Jones Utilities has already dropped 10% in a matter of 6 weeks. So actually less than 6 weeks. And so it's really telling us that there's something happening, and the utilities are related to the interest rates. And that's what we're looking at, because the interest rates, if we get below the 140 level in the June Treasury bond, and we're going to be switching over to the September bonds pretty soon, so that June at around that 140 level, if we get below that, that's going to break a long-term trend line to the downside, and that's going to make that chart look even worse than we already have. So we have to watch these as they're unfolding. And I think it would behoove us all to pay attention to some of these things, because they're really they're very, very important. I want to get the oh dear, here I've got it right here. Hold on just a second here, and if I can, oh dear, that's not going to work. Okay, hold on. I have to figure out some other way to do this for myself, but I've got to post a chart, and I'm trying to figure out how to do it without losing everybody, and that's going to be the problem that I'm running into. So if I can just get, oh dear, well, I'll have to do it a different way, but I'm going to get this chart up so that you can see the pattern that we're looking at. I'm just going to redo it from Ensign. That'd be the easiest thing to do. I'll just do the I'll do it on the weekly basis, and we will go back, and I think I'll be able to see it. Yeah, I can pull it over here, and you'll see this same pattern. It's going to be a little hard to see, but you'll be able to see it from if you go back, and you'll see that the year will be over 2008, and you'll be able to see this same pattern that we're having now that has occurred. Now, I did the weekly chart, and it's also available, on the monthly chart too. So both of those are there, to give you an idea that the same pattern that we're just completing now in the Dow Jones, the S&P 500, the NASDAQ, the Russell, all of those are completing it in the same manner. Some of the symmetry is just a little different in each one of them, but the pattern is basically the same thing. It's that 3-drive pattern that takes you up to that last drive, and it's the last hurrah, and everybody's, wildly excited, and, you're seeing news items in USA Today, and, it's just one of those things that makes you be very, very careful in here, because these are times that if you make a mistake in this area, you can really hurt yourself financially, for a long period of time, because these markets, when they take no prisoners, once they're doing it. Now before we get to the break, I wanted to share one other thing that is relatively important, and that is that historically we have never had a period where we've had this many days in a row without a 3-day correction. Believe it or not, this time in May, in May of 2013, we have gone 100 days without a 3-day correction. We've had a 2-day correction, but we've never had a 3-day correction. That's never happened before, folks. That's going back 90. It goes back. Let's see. Yeah, it goes back 100 years. So it's this is really an outlier event that we have going on here. And as you can see, we've only had about 20 of these days where the market went up and didn't have a correction for more than 2 days, and 62 days, which is 2 full months, a little more than 2 months, because there's month and a half. There's 22 trading days in a month. So this is a very unusual situation where the market keeps climbing higher and higher. Now, why does it do that? I have no idea. All I'm doing is reporting to you, what I'm seeing. I'm seeing this pattern, this 5-wave reversal pattern. I'm seeing it everywhere. It's just really it's quite ominous here, because it's on the monthly charts, and this is long term. And those of you that knew me way back in 07 knew how bearish I was up there in the fall of 07, just as I was very, very bullish in March of 09. And now this is the biggest top I have ever seen in all the years I have looked at charts. Okay, we'll take a little break, and we'll be right back.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direxion Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direxion Shares gives you the tools for both sides of the trade. Discover how we can help at DirexionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direxion Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direxion Shares. To obtain a prospectus or summary prospectus, please contact Direxion Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartley's, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and we've got a call from Rob in Pennsylvania. Are you there, Rob?
Yeah, how you doing?
Pretty good. What can I do for you, my friend?
We were talking about the markets go short.
Yes.
Is there any ETF you'd recommend to short the market?
Boy, I tell you, I don't like ETFs. I really don't know anything about them. There's some really smart people in the Tiger Den and stuff that could probably help you. But if you had to pick one, I would pick one something like don't pick the leverage ones. Those triple leverage ones. Pick something like the diamonds or the spiders, something like that, and use that. That's what I would use. Something that's 1-to-1. Don't pick something that is double or triple leveraged.
Okay.
I'm going to be heavily leveraged, but I've been doing this for a while, so when I'm wrong, I'm going to be able to get out pretty quickly. So I don't want to give you the wrong advice here. So don't trade anything that's just super leveraged.
I've heard the triple leverage. Like I saw this article. Even when it goes down, they sometimes.
Oh, it's a scam game. I think I think they learned from Las Vegas. If you want to know the truth.
I think it's better to buy puts.
I don't like him. I watched TPT. I was right on TPT or right on the bond market a couple of years ago, and was in a TPT position that virtually made a very small amount. Yet the bonds made a lot of money. And so I don't like ETFs. So I let them play their game. I'll play mine, and that's the way I look at it.
Do you think it'd be better to buy puts?
Puts are another thing that's tough because you're buying a wasting asset. the best thing to do is to to sell an option, but that doesn't give you the leverage that you want. I'm incredibly bearish here. I don't know what's going to trigger this, if I'm right or not. But if we have a really bad day in the market with the Dow down more than 600, and we're going to have one of those this year, it'll be more than 600 points down in one day in the Dow without any trouble at all. I feel very, very strongly about that.
So you use futures basically, or? Yeah,
I do futures. I use the S&P futures and the Dow futures and those because they're fair. They have good leverage, and you can get in. They have great liquidity. You can get in and out of them pretty quick. Now, if you're going to play something for a longer time frame, you're going to have to use a wider stop. So you'll have to use a wider stop. I would prefer doing that as opposed to doing an ETF or doing an option.
Okay.
Okay. I hope that helps.
CBT is a pretty solid fund, or you're saying you don't?
Yeah, they're pretty solid. Sure. Yeah, absolutely. Yeah.
Do you think it's too late to short the bond market, or do you think?
Oh, no. The bond market's going to have a heck of a move. It's going to have a huge move. It's just
okay. If you wanted to buy like CBT,
I think bonds are going to go
like 5 years. Would that be?
Well, we've been going 33 years in the bond market, so this thing has just started. We made the top last year. This will be our first down year, and we're waiting for a good rally to get short. I'd like to see it get up to that 146, 147 again, but that's what I'd be looking at there.
And last part of the question, do you think Apple's still going to go up now, or you think it's kind of stuck?
No, I'm not sure. Well, Apple should have rallied more with the market. It didn't. It could only get up to the 786 retracement at that I think it was 460 level. So that's telling us that it's still much weaker than the market. So I'm not sure whether it's going to. It's made a major bottom down here at that 385 level. There's no question about that. The question is we only got a $100 rally out of that, or $80 rally, so that's not much. So we could make another bottom in Apple without any trouble at all, especially if the market starts to weaken up here.
Thanks very much.
Okay, thanks for calling in.
Have a good day.
We've got. I think we're getting ready for a break, but we've got another caller. John, are you there?
Hey, Larry, good morning to you.
Yeah, you're going to have to stay with us because we're going to be in the midst of a break here. So what do you got for us today? And then when the break comes, stay with us and we'll finish it up.
Yeah, I'd be happy to. I'd like to have you look at the HUI weekly chart, please.
Okay. I'm going to put that in because that has that same pattern that I've been talking about, and that is that reverse point wave, that 5-wave pattern that happened in September of 2011 when the gold was trading at $1,932 an ounce, and that was the top of the gold market with that pattern. That's the same pattern that I'm seeing now, in all the stocks in the U.S. and then also globally in Germany and France and England. So this is the same pattern, but this must hold this level where we are now. John, we've got to take a little break here, my friend, and then stay with us, okay?
Will do.
Okay, thank you.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit, and on April 1st, Tom Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN. No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back. John, are you still with us?
Here I am, sir.
Fire away on that gold bug index that you'd like to see. I posted it into Tiger TV so the folks could take a look at us.
Thanks
what are
very
you
much,
seeing
Larry.
here?
Yes. Regarding gold, the gold price itself.
Yes.
Any honest market analyst will observe the bear trend that's been in force in gold for a while here has not shown any turn to the upside, and the same applies to looking at the gold bug index, that portfolio of gold mining equities. What I cannot ignore myself as just an honest analyst is the fact that the HUI index has a Fib 786 calculation at 254. And the HUI has been trading for about 10 days right at 254, leaving me to wonder, is there a bottom forming right at a Fib support mark? My question to you, sir, is there anything that you do in your secret bag of tools that gives you an answer to the question, is HUI bottoming right at that number or not?
I think your analysis is correct, and the reason why my secret bag of tricks, by the way, John, is a little bit of prayer and worry beads, a little more on the prayer than the worry beads. But the gold and silver ratio itself, the gold-silver index has done exactly the same thing that the gold bug index has done. It stopped exactly at the 786 retracement on the long-term weekly chart coming off that 2008 low. And, I think gold has possibly made a very major bottom in here. As long as we don't go below 1,300 per ounce in the gold. And, of course, we're only at 1,389 now, so we could take that out in a matter of an hour or so or less. So, it's got a chance to do it. We need to close above 1,440, I think, in the gold. And that would, maybe get some people start to be interested. But everybody's bearish now. Everybody that was bullish, in September of 2011 when it was $1,900, nobody wants it now. And it's just completed, the major ABCD correction from, the 2006 lows. So it still looks bullish to me. I mean, it's had a big correction, of course, but it's held right where it should have, around that 1335, 1350 per ounce level.
Excellent.
Now, I think silver, my comment on silver is the fact that, it's a lot less liquid, of course, than the gold, and it's more of an industrial metal, and it broke down a lot more than we did in the gold market. But I think that silver could possibly, tag along too, but it's far, far weaker than gold without even being a mystery at all. You can just look at the chart and see how weak silver is compared to the gold.
Larry, I will just add a additional observation for you on that silver. Of course, silver spiked down on Sunday night, the 19th, at 6:15 p.m. It spiked down to a low of $20.25 and immediately started to recover. And what I can't help but pay attention to is that with the exception of that 6-hour interval on that Sunday night, silver is holding above that $21.30 mark, which was the 2008 swing high. And I've always found it worthwhile to pay attention to the following: that prior highs, when exceeded, often become support. I can't ignore the possibility in silver that, in fact, that 2130 area, give or take 50 cents, is significant. So just to
I have to agree with you on that also, and the fact that it happened on the Sunday night, where they can play. But I don't know who they is, but games can be played when there's very little liquidity on a Sunday night. So you can move a market like silver with just probably a few thousand contracts, whereas during a trading day it would probably take a lot more than that to move silver, $1.50 or $2 an ounce. But I agree. There's things happening in a lot of markets that make me wonder. But when markets are really thin on Sunday night, that's the worst time to be trading. I was watching at that time. As a matter of fact, you sent me an email right as it was happening, and I was watching it at the same time. And I was, really watching gold, because that's where, the real players are playing, because you can own a lot more gold in a shorter amount of space, because 1 ounce of gold is $1,600. $1,600 worth of silver, is quite heavy.
Indeed, and speaking of that Sunday night and silver cracking, while doing so, gold was weak, to be sure, but certainly nowhere near as weak, with nowhere near the selling volume that exploded in at 6:15 p.m. that Sunday night. So there we go. So
I agree with that. Most wholeheartedly, I should say.
Hey, Larry, thanks so much for your help. I appreciate it.
You bet. Thanks for calling in, John. I would like to. That's one smart cookie, by the way. I got to know him through Tiger TV, and he is probably one of the better traders I've had the fortune of meeting. But he's a really smart fellow. I'm going to put a chart now into Tiger TV that shows the comparison between the VIX index, where we were a week ago, actually 2 weeks ago before I took the break, and where we were with the Nikkei, showing this 135 pattern where we have higher bottoms. And now the VIX has moved up. It's trading above 15 now in the VIX, and I think this is the real sleeper here, because as the market was making new highs, the VIX was making higher bottoms, and that should not be happening in a really good bull market. The VIX should be just going down into the swirling into the sewer. And it's not doing that. It's making higher bottoms. So it's telling you that there is someone or some segment of the market that is preparing themselves, for something, pretty dramatic to happen with volatility, because that's what it looks like this chart is telling us. If you compare the two charts between the Nikkei, when we were back there in late 2012, this was basically the Japanese yen trade that we like so much because our fearless leader, Tom O'Brien, was, very, very bullish the Japanese yen at that time when it was trading around, 72 to 75 in the Japanese yen. And now, of course, it's in the 102 range. Oh, it's trading around par right now, but it's been as high as, 104. But these higher bottoms are very, very indicative of something that is important. You have to follow the money. If you've ever seen these movies that we always like, I forget what was the Watergate one. I can't remember the name of the darn thing, but it says follow the money, and that's what it is. The same thing with the Federal Reserve or where else. Where's the money going? And that's what you want to be, trying to watch. That's why when we have these big collapses in commodity prices that we get, it's because these hedge funds and stuff have to get out of the market, and they have to get out at whatever price it is because they have margin calls to meet, and they don't want to expose themselves to any more risk. Now, there's no correlation. Someone asked the question if there's a correlation between the VIX index and the Japanese yen, and there is no correlation. All I'm trying to show is the pattern that was happening in the Nikkei of the higher bottoms was the same pattern that we're having now in the VIX index, and that's what I've been, talking about over the past several weeks, is that we're having that same pattern, and now, the VIX has started to move up, pretty strongly, and I think we're going to at least get above 30 in the VIX sometime in the next few months, and maybe even a lot higher, because it got to 96 during 2008. So just making a retracement back could take it up into the mid-30s without any trouble at all. So it's the pattern that I'm trying to show here. It's not that there's any similarity between the VIX and the Japanese yen, because I have not seen that correlation. But I do know that the patterns are the same in any of the markets that we're dealing with. I want to switch over for a second. We covered the gold market pretty well when John was asking the questions, and I wanted to bring up the long-term Treasury bond chart now, because we've completed this chart. This is a monthly chart going back to 1981 when interest rates were 13%, and now we've completed the butterfly pattern and the head and shoulders pattern in the Treasury bonds up in this area. When we get below 140 in the spot bond, which right now is June bonds, I think that's going to start the acceleration to the downside. Now, we might have a sharp rally back from that level. All I know is that, this market is rolling over. We're having lower tops and lower bottoms, and that's the definition of a trend to the downside. If you got lower tops and lower bottoms, you're in a downtrend. It doesn't make any difference whether it's a 5-minute chart, a 30-minute chart, a monthly chart, or a weekly chart. As long as you have lower tops and lower bottoms, you're in a downtrend. If you're in an uptrend, you're going to have higher bottoms and higher tops. That's the definition of a trend, because you have to say what the time frame is. That's the bottom line of what we're looking at here. So I really believe that what we're seeing in the 30-year bond, in fact, all the bonds and notes and everything else, is all related to the stock market. That these big patterns that I'm seeing, they fit together in a puzzle that I don't quite understand yet. But all I know is that it looks very, very ominous from a technical basis. I've been looking at charts for well over 6 decades now, and I have never seen this many bearish patterns across the globe that I'm seeing right now. Starting with the United States, of course, and going well. Europe is doing the same thing we are. They're making the same pattern. But the Asia has been in a downtrend since 2006, so that's nothing has really changed there. But the rest of the world is looking pretty bad. Now, I have not spent a lot of time looking at South America. I will take a look at that probably in the next few days, just to see if I'm seeing the same patterns there. But it's across Europe for sure, and it's definitely here in the United States. And we have larger financial markets here than most other countries. So this is where the big players come when they come in to make their speculation bets in the market. So there's a lot of things that scare me here, and that is, well, everything scares me, but fortunately I handle it okay. When you see so many people that are bullish, like we have bullish consensus now, higher than we've had it in 2007, and you're seeing things in U.S. News and World Report, Newsweek magazine, and also in USA Today. These are really ominous signs, folks, that are very, very foreboding of something really, really bad to come. Whether it's going to be a too big to fail type scenario or not, I don't know. Or maybe it's something that the Fed did that they're not be able to work out of. I'm not sure. We'll see. We'll see what really happens. I'm not preaching the end of the world. All I'm saying is that we are at some really, really major technical patterns. They might have to. They're all going to have to be wrong, and that in itself would be an event that, hey, these other things are breaking records. Why couldn't this break a record? And I could be totally wrong. And if we get above 16,000 in the Dow, then I would certainly think so. But the Bradley model says that we're over it right now, so we got a few days here to see what's going to happen. And this little 2-day sell-off that we've had in the market is, basically nothing. That's basically a non-event. So I don't think there's anything to worry about. Nothing's really happening there. My sell signal, like I mentioned before, is if we go below 1620 in the S&P futures, the June futures are trading at 1642 right now, and if we go below 1620, that would trigger the signal to go short. Now, the reason why I picked that is I picked the lows of the last couple of weeks because that means that everybody that had bought it in the last 2 weeks would be now having a loss. In other words, the last people to the party, would be having bad positions, and they, would start to lose, and then we'll see what happens. But these people will not get out. I can promise you this, because in March of 2000, that we had the same type of pattern occurring in the NASDAQ when it was trading at almost 5,000, and I wasn't affiliated with TFNN at the time, but I was definitely short the market, and that was on March 24th of 2000, and you couldn't get anybody to even think about going short a stock because we had all these stocks that were trading for $400 and $500 that ended up being worthless. But that was a once-in-a-lifetime situation that, I will never see again. Some of your younger folks might see it again, but that will not happen again in my lifetime, where you have the speculation like we had during 1999 and 2000. The whole key to this, and this is my opinion, is the chart that I posted into Tiger TV, and that's that bond chart that goes back, way back into 1981. We're going to take a little break here. And then we're going to talk about the U.S. dollar.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rose, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I want to talk about the U.S. dollar here because everything moves on cash, and this is how we keep score, is with the U.S. dollar. It's still the number one currency in the world. I posted into Tiger TV the chart going back the last 18 months, and we have a very high probability of making a double top-up in here on the dollar index. The reason for that is the fact that it's taken almost exactly 1 year to go back and touch that old high that we made back at that 84.50 level, and we've just been above it just a little bit, and then we've started to back off. The reason why we back off on the dollar index is because the euro was making a 786 retracement at that 128.50 level, and it's only rallied about 150 pips from the bottom, but at least it's trying to find a bottom in here. Now, if the dollar index can get above 85, then it's got a chance to go, a lot higher. But that still, remains to be seen. Now, I wanted to put a long-term dollar chart in here just to show you where we've been here with the U.S. dollar on a monthly basis, going back, just about 30 years, which would be the same as, we're looking at with the Treasury bonds. And you can see, that the dollar at one time was at 165, and then we went all the way down, into the low 70s, and now we're up around that, that 85 level. And, since the last 5 or 6 years, the dollar has just been consolidating at a very, very low level, much like what happened in 1995. If you get a chance, take a look at this. This is an incredible chart because, you go back and see what the dollar has done over the last 30 years, and it has these huge rallies where, it'll rally 50% or 60% over a period of, 4 or 5 years and then go right back down to where it was before. And we've been in this trading range now with the U.S. dollar since 2007 on the downside, and we have not taken out those highs from that 2007 level. That's when we had the debacle in our real estate market, and evidently everything's okay in real estate because the sales are up now 10% year over year, and so prices are back. They're telling us that prices are back to where they were in 2006, and if you believe that, I still think the Tooth Fairy has a chance to come by and visit you one more time before they ring the bell for you. Anyway, the dollar index, the key level to watch here is the 85 level, because we have hit that 85 level 3 times over the past 5 years. So we need to get that dollar index strongly above 85. I mean, probably you need to get it above 86 or even 87, and then you'd have a really good chance, for the dollar to have a pretty good continuation move, and I think we'll go a lot higher. That's it. Give your prayers to Ed Young, everyone. God bless him.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.